Well, after Friday's jobs report, we continue to follow the worldwide employment trends. As support services in the UK services has been holding up so far. We partner now with the FT to bring you Lex on Bloomberg. You get a sneak peek at the Financial Times' flagship column a day early. Luke Templeman joins us now live from London. So, Luke, what is the outlook for this group now? And maybe define some of the contract work, some of the industries it touches.
Sure. In the UK, support services, they're gearing up for a very big year. And this comes from a lot more cost-cutting that's expected this year, as we saw last year. But we're not just talking about cost-cutting from corporates, it's governments as well. So companies that maybe outsource things like pension contracting, paperwork. Now we're moving on and we're looking at government spending. So governments outsourcing more prison work, defence contracting, looking after education, those sorts of things. Now this is big business, because when a government outsources this to a private company, typically they can achieve a 10% cost saving, and that is going to be factored in quite highly into both the US and UK government's plans for spending cuts this year.
And Luke, what does this do, if anything, to the M&A outlook?
Yeah, well, not a lot of industries this year have experienced a lot of M&A activity, but support services is definitely one of them. Now, we've seen in the UK, VT Group is reigniting talks with Babcock, and if that merger is successful, that would become a £2.5 billion company with interests in nuclear, defence, rail, broad spectrum of stuff. Now, VT itself just pulled out of a bid with a smaller rival called Mutual. So a lot of action around there. Now, at the bigger end of the scale, Capita Group, which does lots and lots of corporate pension processing and lots of sort of the boring behind-the-scenes stuff, made no less than 12 acquisitions last year, gearing up for another big year.
And I mean, as soon as we're talking about M&A, of course, we have to look at valuation. How are these stocks, the ones that are publicly traded, how are they priced?
Yeah, well, outsourcing stocks seem to be a great counter-cyclical play, but the flip side is expensive valuations. Now, some of these companies trade at price-to-earnings multiples of up to 17 times and might pay a dividend of, say, 1%, and this means they're priced for growth. Now, even though they know where the bulk of their income is going to be coming from, they have long-term contracts in 10 years or more, it means that they need to bring in more and more income each year and sign more and more new contracts. Now, of course, the risk is, if there is a broader economic recovery, this might curtail plans from both corporates and governments to cut spending. So, ironically, there are some people who aren't perhaps looking forward to a broader economic recovery.
Luke, we thank you as always. Luke Templeman joining us there from London from the FT.